Good morning, everybody. Ed Yardeni here. Let me just adjust the screen a little bit. I'm doing this today on my laptop from New York City. Weather's not as bad as I thought it was going to be. The weather report was for a lot of rain this weekend, which we didn't get much of, and quite a bit today in New York City. But so far, so good. I'm doing a lunch presentation for some folks here. I'm in the Raymond James building on Park Avenue. It's a very nice building, very nice location here. Some art in the background here, so it's not my usual bookcase, but there's a lot of unusual things going on these days, to say the least. We've been talking about Trump tariff turmoil, and that's TTT, not to be confused with Trump derangement syndrome. You have to be very careful these days with what you say. Everybody's still so touchy-feely and sensitive about every nuance of whether you're for or against. I'm all for the stock market going up. That's my first allegiance, if you will, at least as far as what I do for a living, what I do for you folks. I try to stay focused on the market, try not to get very political. I think I've shared with this with you before. I've been doing this for a while. I guess it's almost 45 years. Not as long as Warren Buffett's been doing it, and he certainly has been a great success and great role model for all of us. But I've been doing this for 45 years, and one of the things I've learned, almost a mantra these days, is that it's really extraordinary how well the U.S. economy, as well as the stock market, have done over the years, despite Washington. Most of the focus of strategists and economists and the media and investors, when we're looking at sort of the big pictures, to focus on Washington, on the Fed. The Fed is always good for commentary and for debate. We have an FOMC meeting this week, clearly, and I don't think there's much debate with this one. I think everybody's come around to the view that the Fed is not going to be lowering interest rates. By the way, since this is the first time I've done this on this particular laptop remotely, I just want to make sure that I'm getting across to you. So if one or two of you would just say everything's all clear and okay on the Q&A, that'll be all good. Wonderful. Amazing how technology works. Okay, I got it. Thank you. So anyways, it's amazing how well the economy and the stock market have done despite Washington. And I think that's still the case. I keep pointing out that all of us working stiffs, you, me, and everybody else that works for a living, we're trying to do the best we can for our accounts, for our clients, for our customers, for ourselves, our families, our community, our country. And we're laser focused on doing that. And then, of course, we do have to take some time to figure out what to do about Washington. Washington always seems to be meddling in our business, and we factor that into our daily work lives. And on balance, we do extremely well in that regard. I know that people also get kind of politically partisan about the idea about American exceptionalism, but I think it's a fairly objective view that America is exceptional in many ways, and just because it's been questioned the past few weeks, the past few months, doesn't mean that it's still not intact. I mean, how could America be exceptional at the end of last year and suddenly be not so much? And my favorite, of course, is the Economist front cover story in October of last year. They basically had an America's exceptionalism cover story. It didn't say American exceptionalism, but that was really the piece, what the piece was about. It showed a wad of dollars kind of like a rocket ship, all set to take off. And now the Economist just did four cover stories in a row that were questioning American exceptionalism, questioning the dollar, questioning the U.S. economy, questioning the leadership of the current administration and where it's going to take the U.S. and the world. And so it turned out to be a great contrary indicator because we've had an amazing rebound in the market since April 8th. I guess taking the position that I've had for a while that April 8th made the low in the correction is not that bold a statement anymore, though there are, I noticed that some of the bears are still kind of viewing this as a bear market rally or rally in a bear market. And I dispute that. Clearly, there's a lot of volatility in the markets related to what's going on in Washington, D.C., and how Washington is interacting with the rest of the world. But I think we have seen that the administration is not as committed to some of the statements they make. And certainly this president changes his mind quite a bit. And I did warn you along the way that I reserve the right to change my mind as often as the president. But that doesn't really cut it in this business. You do have to have opinions, and you have to kind of support them and stick to them as long as you believe them. And so I think the U.S. economy is resilient. Over the past 3 years, as you know, we've been saying that the economy is resilient, that it would surprise us, would not have a recession with the Fed raising interest rates so dramatically in a monetary tightening cycle aimed at bringing inflation down. In the past, that's just about always meant that would cause a recession, because the best way to bring inflation down, obviously, is to have a recession. But we argue that the consumer might surprise us, that the baby boomers are retiring, and retiring baby boomers are sitting on 80 trillion, not billion, $80 trillion of net worth. And we got a little bit shaken by the market taking a dive and with that thesis, because it could obviously work the other way. And I do have friends who've retired. I haven't retired. I find this just too much fun. What we're all doing. But some of my friends who are retiring, 6 to 9 months ago, I was getting text messages from them that they were having a blast on their latest cruise tour, and that they were particularly happy to see the stock market go up. I mean, what a great way to retire when you can spend money and then you look at your net worth, and your net worth's actually going up as you're spending money. I've posited, I still believe that the savings rate's going to go negative as more and more baby boomers retire and spend their retirement assets. They don't have income other than dividend income and interest income, and for some that's substantial. But for the most part, retiring baby boomers are going to be spending money and not earning money, not wages and salaries. And so the savings rate could go negative, and that'll be a big boost to the economy. And I think there's also a lot of intergenerational income and wealth transfers going on between the baby boomers and their kids. I know this from personal experience, and Peter Lynch taught us that we should all look around ourselves and see what we're doing and what our friends are doing. Well, over the past few weeks, friends who were on cruises were not the texts weren't so happy. They're saying that cruise is going well, but they're getting nauseous from watching the stock market. And Ed, what do you think? How much lower can it get? And there's a lot of pessimism, even on a cruise ship out at sea. But now the negative wealth effect is less negative. And I think we can go back to the idea that the consumer is going to stay resilient. Of course, it's important that not only retiring baby boomers spend their money, which I think they will, and that they're not scared that their net worth is getting wiped out by a bear market. I think it's just as important that we have solid employment gains, and so far so good. We'll see. The initial unemployment claims spiked up a bit. They're still under 250,000. but this past week they spiked up. I think it was 240, 244,000. It had been ranging around 220,000. So we'll see how that develops up ahead here. It was an odd kind of number because when you looked at the numbers for by states, uh, New York State was up 15,000, which are basically accounted for most of the increase in initial unemployment claims. Meanwhile, the ADP number was disappointing, but it's also not a terribly good indicator of what payroll employment is going to do in the official numbers. And the official numbers were just fine. They were 177,000. That's the good news. The bad news is they revised the previous 2 months down by around 50,000. I'm doing this off the cuff, so I'm not giving you exact numbers, kind of ballpark numbers, but that's pretty close to what was happening. So now the 3 month average increase in payroll employment is around 150,000. That's pretty good. That's decent. By the way, we thought this number that came out on Friday would be somewhere between 150 and 170, 150,000 and 175,000. So it turned out to be somewhat better than we thought. But the consensus was looking for less. And obviously, because it was more than expected, we had a nice run in this in the stock market, obviously on Friday. And now we've had a 9 day streak, which doesn't happen too often. I think it happened 20 years ago, 9 day streak of gains. I suspect the market will take a breather here. But the question is, where do we go from here? And we today, or really over the weekend, announced that we were lowering our recession odds from 35% back. Let's do that again. Lowering from 45% down to 35%. I hope things continue to work out, that we can continue to lower that. And I don't guarantee you that we won't be raising it. Again, kind of dependent on some of the rapid changes that occur on a regular basis out of Washington. But I think Washington has demonstrated that they do care about the stock market, they do care about the bond market, and they do care about the midterm elections. They're not talking about it, but they got to know that the midterm elections aren't all that far out. And between now and then, I don't think they want to have a recession. And meanwhile, the other reason I think they want to get this tariff issue resolved is there's a lot of court cases that are popping up where conservatives are challenging the right. There may be some liberals, for all I know, but I know there's some pretty well-financed conservative groups that are challenging the right of President Trump, to announce an emergency, a crisis, which doesn't seem to be warranted description of what's going on here, but to use that crisis description to take wartime powers. I'm talking about trade wartime powers. So I think the administration is going to declare victory in a lot of trade over the next 90 days period of postponement of the reciprocal tariffs. So that period will end in I guess July 9th or thereabouts. And there'll be lots of 5 page documents, letters of understanding, agreement between us and lots of governments that say that lay out a framework for fair trade. There's no way you can negotiate a trade deal in 90 days and implement it in 90 days. So I think there'll be a lot of show, but on the other hand, I think something will be accomplished. I think there will be movements towards freer trade, not just with regards to lower tariffs, but also with regards to non-tariff barriers to trade. The news is kind of mixed on China. We kind of looked at the Chinese situation and said, they do have the ability to withstand more pain than Americans do, and that's partly because of our different systems. They've got an authoritarian system. An authoritarian system can inflict and cause pain and force their populations, their citizenry, to tolerate pain longer than occurs in democracies. So I think here in our democratic country, there's certainly some pushback on what the president has done, uh, and I think that's acting as a checks and balance on the power of the president. And I'm all for checks and balances. I'm a big fan of Madison, big fan of the Constitution, and if we now also have the bond vigilantes and the stock vigilantes maintaining law and order, that's a good thing too, in my humble opinion. So that's where we are in terms of the trade issues. So the apparent easing in the trade issues, the postponement for 90 days, the recent talk that China and the United States are just trying to figure out ways uh, to to talk and to come up with some sort of agreements. That's one good reason for becoming a little less concerned about the prospect of tariff-related recession. Another one is the resilience of the economy. There's obviously some areas of weakness when it comes to the soft data, but the hard data looks pretty good. I know real GDP didn't look too good in the first quarter. It was down 0.3%. But the wonderful thing about our business is you can dig a little bit and say, well, take out this, take out that, and things look different and kind of can support my story. Take out imports and just kind of focus on spending by consumers and spending by business. So the final sales to domestic purchasers in the U.S. That was a strong number. It was up 3% during the first quarter at an annual rate. And if we see some moderation in imports in the second quarter, as was bound to happen because there was a lot of front running of the tariffs in the first quarter, that'll help to give us some boost for the economy. And if we're right about the consumers will continue to spend, and they do continue to have will continue to have employment gains. Now, how about capital spending? A lot of talk about capital spending being down because of uncertainty. Well, that certainly didn't happen in the first quarter, though uncertainty really got heightened in February, March, and April. So, anyways, with regards to capital spending, it was very strong in the first quarter, and it was strong in the areas that you would weren't surprising. Uh, Information technology equipment was up, I think, around 20% at an annual rate. And that was a big positive for capital spending. And I think that the reason for that was that data centers. And so we still have the controversy of the deep seek revelation that AI can be large language models can be produced more cheaply, more rapidly, and more effectively with other kinds of codes, maybe even consume less juice, electricity. And so therefore, maybe we don't need all these additional data centers. Well, these data centers are really all about the cloud, and anything that leads to more data being processed online on the cloud is going to lead to more demand for data centers and for all the servers and the chips that go into these data centers, and put a lot of pressure on our country to come up with more electricity so that we can make this all happen. And so I think capital spending isn't necessarily going to get washed out by uncertainty. And meanwhile, there have been announcements of more money coming into the United States for onshoring. It's not as though this is just the beginning of onshoring. We've seen onshoring taking off under the Biden administration, and a lot of those projects are finished, but other projects are still in the works. So they're not going to suddenly be stopped by a little bit of TTT, Trump tariff turmoil, which hopefully is getting less tumultuous, or at least the markets seem to be getting more used to it and moving on from there. And I think the administration wants to move on to the tax cuts, which, as we know, aren't really tax cuts. It's just an extension of the tax cuts. But you know, getting it through Congress would be a positive for the economic outlook to the extent that if we don't extend the tax cuts, then they effectively become tax increases. Well, what about the stock market? A heck of a recovery here in the market. I think there's something called the Zweig thrust indicator that says that this thing's got a lot of power behind it. Clearly, there's a lot of liquidity still out there. Remember, liquidity, there's about $7 trillion in money market funds. A lot of people just learned once again that if you're great at calling tops in markets, make sure you're also great at calling bottoms in markets. I think I have a better record of calling bottoms and tops, but we did argue at the end of last year that we could have a correction because bullish sentiment was so ridiculously high back then. And then on April 7th, 8th, 9th, we argued that there was too much bearishness. And so the sentiment indicators looked quite good. And in the morning briefing, I quote something we wrote on April 7th. So that was basically the Sunday before the postponement of Liberation Day on April 9th. And what we wrote is that, uh, all that really has to happen is for Trump to postpone the tariffs, and we'll have a V-shaped bottom in the stock market. Um, I wish I'd listened to that advice myself, but it happened too fast to become a multi-billionaire on that idea. That though, if you move fast enough, when you have these kind of market moves, you can get a return that sometimes takes a year to achieve. Well, let me see if this will work. Let's go and share some charts. So far, so good, right? I hope the audio is good and that the video is good. And I've got a touch screen here. So let me run through a few charts real quickly for you. This is something that David Yardeni, who is related to me and my son, he's become sort of our Jedi master on running charts. And by the way, if any of you would like to have a customized chart book that automatically update, David's your man. He can do that real quick, and you can always add to it and edit it and so on. Figure one shows the expectations. Let me say, I hope that you can see the full chart because I'm on my screen. I also have the Q&A thing. Let's see. Let me make sure I don't screw this thing up. Anyways, so there we go. I'll move the Q&A. Okay, so we're looking at here at the recession odds based on the Poly Markets trading platform, and you can see that we were like around 20%, and around mid-March, this thing just shot up, and then of course with Liberation Day, it shot up even more. It's been kind of fluctuating around 55%. With the batch of indicators before employment came out, we had some weak numbers, and so we went up to something like 65%. Now we're back down a bit. Obviously, the stock market, which is a component of leading indicators, is disagreeing with the idea that there's going to be inevitable recession. Figure two is the stock market back to crossing above its 50-day moving average. Maybe that'll turn out to be resistance, as the technicians say, and maybe it'll be a little bit hard to get through there. But all we need is a trade agreement a day, and that should help to support the market. This is just a chart that put together on S&P 500 sectors performance, and you can see we show you what the percent change was from February 19th when the S&P 500 peaked down to April 8th, the day before the postponement of Liberation Day. So April 8th was the low in this correction, and that's what it was because we weren't down more than 20%, as you can see here. And then we've reversed course, and now we're 7% away from the record high, which is pretty impressive. This is okay. So now the bad news. The bad news is the regional and the national business surveys got pretty depressed here with all this tariff turmoil, and you can see that the average of the regionals is down. The national index is down too, though not as much. Then we have the kind of a stagflation scenario. Stagflation scenario. Can I help you? Uh, okay, you can come in. um, I was my host actually. Um, there's a stagflation scenario here where you can see the survey data looks pretty weak, and meanwhile we got some price inflation. But the survey data was quite weak, as you can see in this environment, and yet the economy was growing. And Again, that was because the consumers kept spending and capital spending remained strong. But there is a stagflation risk still in this marketplace, and that's included in our 35% subjective probability. Let's see, let's move on here a little bit. The leading indicators are depressed. One of the biggest depressing factors is consumer expectations, and you can see that it's down to levels that have been consistent with previous recessions. And so you could still look at that and be concerned that consumers are going to retrench and cause a recession, but meanwhile, they continue to spend. I've often said, and I'll say it again, Americans are great when we are depressed. When we're happy, we spend money. When we're depressed, we spend even more if we have it. And so far, the employment numbers still mean that consumers are and have money. And of course, the baby boomers have money in their retirement assets. This is the leading indicators. Again, it's been bearish on the economy for a long time, since 2022, and yet the coincident indicators, which is kind of like a monthly GDP, all-time record high. This is the forward earnings versus payroll employment. It just kind of we kind of view these as leading indicators. Well, the payroll employment is actually a coincident indicator, and forward earnings we kind of view as a leading indicator. Forward earnings are starting to look a little toppy, quite honestly, but that could change if Trump's policies become if Trump declares victory, as we think he will, in his trade wars and negotiations. There is a downdraft here in the production index. This is manufacturing aggregate weekly hours. They're down, so that's something that will probably weigh on the coincident indicators. But meanwhile, aggregate weekly hours, there's no recession there. It took a big jump back here. It edged up to another new high. This is I'm not going to go through the whole thing there, but there's our earned income proxies in there, and it rose to a record high in April, which means that we'll probably get a good retail sales number. And there is probably going to continue to be some front running buying in advance. We see that in car sales. They were quite strong at 17.3, a little downdraft, but people clearly are buying cars partly because they have heard news that these car prices are going to go up. Employment still looks good on a monthly basis. The areas where payroll employment's been strong has been service producing, and you can see that healthcare is a big number, leisure and hospitality, and financial activities. Well, those all happen to be areas where baby boomers are probably doing some heavy duty spending as they've been retiring. Payroll employment diffusion index looked okay, certainly not recessionary. Well, how about why not raise earnings and valuation and say the market? I was just kidding. I'm still back to 7,000 on the S&P 500 by year end. Why leave it at 6,000? Well, 6,000 is actually remarkably optimistic, all things considered. Basically, forward earnings would have to be $300 a share next year. And at the end of this year, you'd have to get analysts' consensus expectations around $300 a share. Multiply that by a multiple of 20, which is not exactly a cheap multiple, and you get 6,000. You can do it with a lower, you can do like 275 on earnings per share with a 22 multiple and get there. So it's still, the 6,000 is a heady number still compared based on the fundamentals. Market feels like it wants to thrust right through there and get us back to multiples that aren't exactly going to make us comfortable. But I'm going to stick with 6,000 for now. I'm not going to raise my numbers, and until further notice. But there is an issue here with earnings, and that is this is corporate profits. This is customs duties, and customs duties, as you can see, are on the verge of increasing significantly, and custom duties are paid by American companies. And then the only question is, are they going to be able to pass them through? Some may not, like GM, the auto industry, is certainly going to have trouble passing these through. So to a large extent, we need to think of customs duties as a corporate tax. So for all the expectations that when Trump was campaigning that he might actually lower the corporate tax rate, the immediate impact is actually to increase it. So we're thinking about that and trying to figure out what that does to earnings. But a lot depends on, of course, how these tariff agreements go. And then we've already had a very decent increase in the valuation multiple, and it would be kind of nice if it just kind of settled here for a while. But now market's got its own logic, and we try to do the best we can to keep pace with it. Look, I overstayed my welcome. I also didn't bring my other glasses for reading things here, but let me see if I can get a couple of questions in because we got maybe a couple of minutes here. Don't you like the sophistication of my system here? Um, no, I'm not doing too well. Keep getting the Q and A's here. Well, let's see. Yeah, no, I'm not doing well on this. So we'll just I apologize. We'll pass on the Q and A for now. Have a great week. I know it's been a crazy time here, but it's nice to have it crazy the way it's been the past couple of weeks, as opposed to the previous few weeks. And I'm not buying into the idea that this is a rally in a bear market. I think the bull market's still intact. We had a correction. It was 18%. It didn't last very long. There'll still be challenges up ahead here, but I think the bull market is intact. So with that, thank you all very much, and let's do this again next week when I'll be doing it from the home office.